So CalHFA product has multiple options, but we're going to focus on the conventional product. My home is determined by the down payment, which has 1% simple interest. And for those who don't have the closing cost, can apply for the ZIP, covering the closing cost up to 3% of the sales price. And there's another feature called My Access, covers 2.5% of the loan amount, which can be used towards the down payment and the closing cost. So the My Home and My Access can be combined into one, giving the maximum feasibility of 5.5% of the home value. The borrower requirement for this product is to apply the loan with CalHFA approved lender or broker. Minimum credit score for the government products are 640, conventional products are 680, and this is only be available for the first-time home buyers. First home buyer education is required along with a 1-year home warranty, and this is only covered for the 1-unit property, single family, condo, townhome, and manufactured home. And this is the income limit that was updated on June of 2025. And for those who cannot afford the higher payment can look into this product called Dream for All. This is another product that is covered by CalHFA. Dream for All covers a 20% of the home price. We anticipate this product to open up on early 2026. The first phase started on April of 2023. Second phase started on April of 2024. So the baseline was the Good Friday. The first phase started and ended on Good Friday, 12 o'clock. Second phase started after the Good Friday and opened for about 2.5 weeks and closed. And then voucher was coming out on month of May. So will we have a similar trend? I think so. We will somehow prepare all the pre-qualifications before March. So the first set of vouchers are anticipated to come at around April or May. So the main product highlights that is very different than other down payment assistance are following. First, this product covers a 20% of the down payment or closing cost not exceeding $250,000. So when the home price is lesser than $750,000, we can anticipate 20% of the sales price. When the home price is at $750,000 flat, we can receive maximum $150,000. When the home price is, let's say, $800,000, we can only receive $150,000 as down payment, and the remaining will be either be covered by the extra funding from the borrower's contribution, or since the down payment is lesser than 20%, now the private mortgage insurance will kick in. The monthly payment will go up. This product allows 2-to-1, 1-to-1, or 1-to-0 temporary buy downs, and home buyer must be registering for the voucher process and this randomized drawing. Some call it lottery system, but I don't like that pronoun. It's because it's not given for free. It's not a grant. You have to give this money back to the agency when you refinance for the second time or sell. So I want to specify this as a randomized drawing process. Registrant will be selected and receive vouchers and will be able to use it, which is good for first 90 days. And these individuals can extend it for extra 90 days, but I don't know if 2026 underwriting guide will allow for extra extension. The vouchers that were not used are still floating around right now. So this funding allocation from 2024 is still floating around in 2026. So I don't know how they're going to work on it. If they didn't allow the extension, they probably have finished it and were able to reopen very fast. The reason for the people giving up the vouchers are two. One is the income limit exceeding their current wage. And second, they couldn't wait for this 1.5 years, so they ended up buying this home after receiving the notification that they're in a wait list. Eligibility for the product is the following. All borrowers must be first-time home buyers. So if I'm a first-time home buyer and my wife is not, we cannot apply the loan together. And at least one applicant must be the California resident. At least one applicant must be the first-generation buyer, which is defined as the home buyer who has not been on the title, had an ownership interest, and had named a mortgage to a home. It could be a permanent foundation or a vacant lot in the United States in the last 7 years. So for example, if I had a home in Canada, China, Korea, and move overseas, I will be the first generation buyer and a first home buyer. If I had a parent who owned a home in the last 7 years, and if we both reside in the same occupant, then I will be the first time home buyer, but I won't be the first generation buyer. If I had the home in Texas 4 years ago, didn't claim this as my primary residence on my personal tax returns for the last 3 years, I will be the first time home buyer, but not a first generation buyer. Okay? So this definition can be interpreted in so many different combinations. That's why you'll be able to hear and see many buyers who cannot apply elsewhere but through us, vice versa. We may accidentally make a mistake denying the loan, but seeing this person walking away to another mortgage broker or lender and be able to get this voucher. Second, the best of the home buyer's knowledge is whose parents are biological or adoptive do not have any present ownership interest in a home in the United States. Meaning, if I had the father who went through a divorce 10 years ago, but he's still around, he still, lives in United States, had a home sometime in his life within 7 years before I apply. And if I present his full name and the data catches that he has a home ownership interest, I will not be able to claim that I'm a first generation buyer. When we apply the voucher, we have to provide the both parents' information. So one may say, I was adopted, I don't know who my biological father's information or this adoptive parent's information is. Or if this person was in a foster care, have no information to provide, then we have to provide a birth certificate. We have to walk in, get a certificate, and present it to the CalHFA to make sure the loan applicant is a first generation buyer. And third, out of home residential care for a large group of children can be done. This can be very, very different case. Giving Tree helps to repair the credit history and the details. That's where we shine the most. If we find it, they will find it too. But we also know how to cover it up so they can be presentable as a first generation and first time home buyer. So you can also do it through annualcreditreport.com. Tell to the bureaus that this information is incorrect. This takes about 60 to 75 days to reflect the updates. But if you use one of our services, you can do it in less than 3 to 4 days. Which also leads into another question. When a client says, do I need to hard pull my credit? If you have specific things that you want to cover up, yes, you better hard pull your credit so we get to navigate properly. Income limit is slightly lower than regular CalHFA products. Regular CalHFA products, income limit in Orange County is $270. LA is at $211,000. For Dream for All, it's $216 versus $168. $168,000 versus $216,000. So approximate of $54,000 are shy, lower than the other product. The first one that doesn't give you enough down payment assistance is encouraging you to get this fundings, whereas Dream for All is oppressed. They don't want you to apply when you're making too much. So you have to also indicate how to present the buyer's income limit and the application. Applicants must complete a pre-registration application to screen for eligibility through our Dream for All pre-registration portal, which will be opened up later this year. And CalHFA lender pre-approval letter that looks like this will be filled out by one of us. The applicant will receive this PDF copy and upload it to the portal by themselves. They need to take the 1-hour California Dream for All education on top of the 8-hour course. The 8-hour course can be done through online. It was available 24/7. But this 1-hour course is a one-to-one in-person or online meeting where you must present yourself. And when we were opening up in 2024, I had a note saying that the buyer was waiting for 3 weeks for this 1-hour course to be completed. There were 17,000 people applied and only 1,400 got the vouchers. Imagine the number of nonprofit organizations, educational department offering the services, collecting 100 to 150. It's too much. So there was a local agency that we were working with in Orange County who are charging $250 for 1-hour course. and they were working overnight. And we had to make some stuff up so that we were able to streamline the application process. Dream for All pre-approval letter is needed, along with the unexpired identification card, passport, driver license, permanent residence cards, visa, or employment authorization documents. Proof of resident, government ID, utility bill, cell phone bill, insurance bills are needed on top of the identification card. And foster care documentation is also needed if applicable. The product specification talks about the shared appreciation. CalHFA wants to work and act as a bank. They want to take 20% of the home appreciation on top of the money they were lending at the time of the sale, title transfer, or second time of refinance. When they are selling, it's obvious. You have to repay. When the title is moved, which also means is my home owned by individual name moved to my corporation, you have to repay. If the name is now added to my wife's name, and if I take my name out from the scene, you have to repay. Adding my wife, adding the title into trust, which has the trustor trustee relationship, that's allowed, that's available. But anything outside the scope will be audited and you need to repay. And for the first time refinance, when the rate is lower more than 1%, you can do it without repayment. But on the second time of refinance, you have to go through the procedures, work on the repayment of full amount that you are lending, plus 20% of the appraisal value. So these are the examples. When the equity has been grown more than, let's say, $100,000 in the midst of 5 years, then you have to take the 20% of the $100,000 plus the money that you are lending. So Q&As. If your borrower's spouse owns a property in the last 7 years, can you apply? No. Can you bring your friend as a co-signer? Yes, if they decide to live together as an occupant co-borrower. Non-occupant co-borrower, meaning a friend in Michigan applying the loan together with me in California, are not going to be allowed. Assistant money distributed to pay the closing cost? Yes. The 20% attribution can be divided into two factors. One, 15% going into down payment, 5% going into the closing cost. Can we refinance? Yes. Only for once when the rate is more than 1% from the original note rate. How much money can I get? 20% of the sales price or $150,000, whichever is lower. When will I pay back? Number one is when you sell. Number two, when you refinance for the second time, or 30 years later when the life of the loan matures. What is a shared appreciation? Is a 20% of the increment of the home plus the money you borrowed. You keep the 80% of appreciation. Is it a bad idea to give up that much equity? It is a lot of money, but you don't have to pay for it in the front. You are trading this funding with opportunity cost. If you are paying $4,000 in rent right now, why don't you find a home that has a payment of $4,000 so you can get into this home ownership journey and expect to get some money back at the time of filing tax returns? Can your uncle pay the house in full cash and you live in there? That's perfectly fine, but you're only making your uncle rich. But don't you want to be rich like your uncle as well? Why don't your uncle just buy a home and rent elsewhere? You occupy, your own home. A lot of people who worries about their future talks about this question, but our job is to motivate and encourage these home buyers and applicants to go to the next level. They have to be richer. They have to be overflowing with financial opportunities. So we get to have another option to either refinance or help them with another purchase loan. Can your friend decide to purchase a home together? Yes, we can divide the home ownership vesting. When we do the vesting and equity ownership, we can do 50-50. Can DACA applicants apply? They can apply for the regular CalHFA, but not for Dream for All. This is only available for the US citizen and permanent residents. What qualifies a buyer as a first generation buyer? No ownership or mortgage interest in the last 7 years, meaning if I purchased a home with my brother 8 years ago, but unfortunately, sadly, that I was claiming some piece of interest, participation through my personal tax returns, then I will not be able to be classified as a first generation buyer. That's why CalHFA is demanding mortgage brokers and lenders collect the 1040 along with W-2 copies. Both parents must not currently own a home. If parents are deceased, they must not have owned the home at the time of death. only one borrower on the loan must meet the first generation requirement. When there are 4 borrowers applying together, all 4 must be first-time home buyer, but only one can be the first generation buyer in order to complete the checklist. How are the borrowers treated? If they spend time in foster care, any borrowers with documented foster care history is automatically considered as a first generation. But at the same time, you have to provide a birth certificate with this because you don't need to provide any parental information. What if the borrower has incomplete parental information, was born out of born outside the United States? Parent information is complete, no birth certificate is needed. If information is missing, borrower must provide a birth certificate or adoption documents. If either parent owned the home, borrower does not qualify as a first generation buyer. How are the student loans calculated for DTI? When we go for the income-driven repayment option, we can bring it down to 0. But if we leave it as a deferment, we will apply the 1% rule of the remaining balance. So when we have some time, for those who have student loans, better apply today so that they have some time to confirm this IDR, income-driven repayment option. Are older borrowers eligible for CalHFA? Yes, there's no age restriction. How does the Dream for All repayment work? Especially if the homeowner passes away. Repayment triggers at the time of sale, refinance for the second time, or 30-year maturity. Borrower shares 20% of appreciation with the state. If they're transferred via living trust to an heir, no immediate repayment is required. If heir sells the property, then repayment and shared appreciation becomes due. So for example, we borrow this Dream for All. Can we convert this into rental? Absolutely, we can. This doesn't specify about the occupancy change. A lot of people miss that part. You can buy this home, first-time home buyer can convert this transaction into, or this property usage to a rental when they're purchasing another home. You don't have to touch that loan. But think of it this way too. If you accidentally keep it for 30 years, you have to give back 20% of the home appreciation to CalHFA. If the $1 million accrued appreciation happened, you have to give back $200,000 at the time of the resale. So my recommendation is to take care of it as soon as possible, when you can afford it. What are the chances of being selected for Dream for All? The previous round was about 18,000 people and 2,200 were selected, which still hasn't been used yet. It is randomized drawing plus the wait list, so you don't guarantee the options or possibilities. Does the CalHFA allow construction loans? No, they do not. But is Giving Tree offering one? Yes, with conventional and FHA options, up to the county loan limit. So if it's 1 unit, we can go up to $1.249 million. Is it true that CalHFA loan takes longer than close? No. This is actually taking lesser than regular purchase, or same as regular purchases, because we already went through the income, asset, and credit even before we begin. When the voucher comes and escrow opens up, all we need to worry about is appraisal. That's why this is faster and easier than other FHA or conventional loan products. Or you can simply say that it is as fast as traditional products. What should an MLO say when a borrower says, I don't think I can qualify? Loan officers have to say and qualify these clients and push them away from the self-disqualify mindset. We have to encourage the borrowers to start the conversation and provide the credit or detailed improvement plan so they can layer these products of CalHFA plus others and get it done, right? So if you may ask, can we combine CalHFA Dream for All with Green Line in LA County? Absolutely. Absolutely we can. Up to CLTV at 105. A lot of people miss this part. And that's why within LA market, Giving Tree will thrive and monetize. There's no or very few individuals, companies who can do this all at the same time. A message that I want to deliver is the self-disqualification is the biggest barrier of home ownership. We have to be educated and to tell them what is right and wrong.